Well, thanks for having me or coming to our event. I think, as Kara said, just want to set expectations that this is fairly experimental. Big thanks to Kara. Kara came onto our team actually just a few months ago and has really started helping us like scale up our content. So hopefully we can be a little bit more useful to more entrepreneurs. But Kara really has done a lot of events and marketing things before, so she's an expert. But I have to say, for both of us, like this is pretty new. So setting expectations here, we've never done an online event this big before. So there may be some hiccups, including the Wi-Fi or other things we can't figure out, but please bear with us. I guess you get what you pay for. So anyway, thank you for joining us, and I'm glad to have you all here. So we're gonna hop right in, and as Kara mentioned, I have a bit of a presentation, but it's relatively short. I want to actually reserve most of our time for questions. You can feel free to throw in your questions right now or throughout as it comes top of mind. You can also feel free to ask your questions later when we get to the Q&A section. I think unless there's anything pressing, we'll most likely address all of the questions at the end. So with that, I think we're just going to hop right in. I assume everyone can see my screen. Is that right, Kara? Okay, we'll go right to it. So in case you are at the wrong online event, this event is about raising money from angels. And I think the biggest thing here is, how do you do it? I think a lot of people want to do this because VCs are rather frustrating to raise from, or you may not be the right type of business or stage to raise from VCs. So the angel investing process is rather a black box, and hopefully we'll answer all of that today. Just a quick bit on my background. So my name is Elizabeth Yin. I'm one of the general partners here at Hustle Fund, which is a relatively new fund. We are a, quote, pre-seed fund. And what I mean by that is we invest in very early stage startups in the United States, Canada, and now Southeast Asia. And we are looking basically to invest in software companies that can make money right away. And so usually like a B2B type of business or a consumer business where you are selling something. And we're looking for products that are pretty built, you could say. Like, we're not looking to invest in ideas, and we don't actually care about traction. So I think that's something that's fundamentally different between us and a lot of VCs. I previously was a partner at 500 Startups, which is a global accelerator based here in the San Francisco Bay Area. And prior to that, I was a founder myself of an advertising technology company. So I've seen all sides of the, I don't know what you call it, the ecosystem, being a founder myself, having gone through a lot of fundraising frustrations as a founder, having run an accelerator where I've helped a ton of companies raise money from both angels and VCs, and then now being a VC on the dark side myself. And I've done over 300 investments in my career across all of this. So let's first break down what this presentation is going to be about. I think the first thing is it's important to really dissect investors. Investors kind of come from all walks of life, both VCs and angels. And so we want to kind of describe that landscape. And then we'll dive into tactics. Like, what is the strategy that you should go about in order to raise angel money? And then also, what specific tactics do you need to use to close? And then we'll go into Q&A, and I'm sure there'll be a boatload of questions. Feel free to ask questions that pertain to your situation. And I'm sure that will actually probably broadly apply to many people. So I think the first question, and we're going to try this in a somewhat interactive way, is why do people invest? Just in general, VCs, angels, etc. And go ahead and throw into the comments like why you think people invest, and then we'll quickly kind of go through that. So go ahead and start typing or whatever now. What are the reasons that you can think of? Any and all reasons for why people invest. Kara, what are some of those reasons that you're seeing there?
To make money, to see return on their investment, to make money with 2 exclamation points,
Okay.
Disposable income.
Okay.
Starting something new is fun.
Okay. All right. Well, let's just kind of dig into it. Yes, to make lots of money, I think that was probably the #1 answer. But I think there are also many other reasons why people will invest. And this is important as well. Angel investors, for example, it's their own money. And so they basically just have to consult with maybe a spouse or family members to decide whether or not to invest. They can do whatever they want with their money. They don't have to invest. They could buy a swimming pool. They could go on vacation. They could buy a house. They could, build a money bin and swim in that. They could do whatever they want with their money. And so there are many other reasons why angels invest. And this is really important because for some of you, it may be these other reasons that are actually more compelling than to make money. So, for example, an angel investor may want to invest because they love your product. If they just, you think about some of the best products out there, like they just may really love using it and want your product to continue. It's not so much that they are looking to maximize the money that they invest in your company, but rather they want to continue using your product. Maybe they're passionate about a problem or a mission, like especially if you're going after something that has some form of impact. It doesn't necessarily have to be, a nonprofit. It can be, anything really. Like Google, for example, has a big impact with their search engine. It kind of democratizes information across the world. It could be that they just love you as a founder. People gravitate towards people that they like, and that is a reason in itself to invest. The other reasons that people invest are actually a little bit less spoken of. So, for example, there are a lot of angel investors who actually invest simply to network with other investors. Here in the Silicon Valley, actually, one of the biggest secrets is there are a lot of people running around San Francisco who are angel investors, but they're actually only investing like $1,000 in each deal. And for somebody who is either relatively frugal or is a professional of sorts, $1,000 is actually fairly doable. And if you think about it from the perspective of I am buying network, like when I invest in this startup, then I had the opportunity to network with the other investors in that startup and then meet more people off of them. Actually, it could be, a good rival to even business school. And so that's actually a big reason why investors invest. And in fact, many of these investors even have their own startups that they're, of course, raising money for, and then they can pitch those other co-investors. So that's another strategy to utilize. I think the last two also are lesser spoken of. Like, some investors just really want to learn about a new area. So 2 years ago, when blockchain was really hot, a lot of investors invested because they wanted to better understand what is this technology, why is there all this hype, etc. In some cases, it may even be to show off. Like, I got into this deal, but they didn't really care about making money per se. It's just always fantastic to be able to say that, I got into Google like in the early days or whatever. So these are a lot of the major reasons why people invest. And I would definitely keep that in mind, because I think when most founders pitch, they focus on the first reason, which is, hey, we're going to make you a lot of money. But the reality is there are so many money-making opportunities out there for both VCs and angels. It's actually a little bit challenging to compete on that angle alone. Like, an angel investor could invest in real estate that is like growing in a really hot area, and that could also make them a lot of money. They don't have to be investing in your startup. So let's continue with that. The other thing I want to do is really dissect the landscape around what are the differences between angels, VCs, and corporates. Now, of course, there are other types of investors as well, but these are probably the three buckets that you guys are coming up on. So for angels, they have flexibility, as I mentioned, to invest for whatever reason they want. And it's up to you to kind of figure out what is the right angle to pitch. And the due diligence process is relatively quick. It could be just getting buy-in from that one individual himself or herself, or it could involve maybe a spouse or a family member or multiple family members. It will depend, but in general, there isn't the lengthy due diligence process that a VC or corporate might have. And their own capital allows them to have flexibility, unlike a VC who generally has a mandate. So the check sizes can also vary. It really depends on how rich this person is that you're approaching. So let's quickly talk about VCs and corporates. This event isn't about VCs and corporates, but I think it's important to compare and contrast. One of the reasons it's so frustrating to pitch a VC is they're looking to maximize ROI. It's not, and this is what I did not understand as a startup. I remember coming out of a notable VC's office, kind of dejected, like, they just really are not that interested in my business, even though it's going to be a great business. Well, great is actually not enough. You have to be like the number one deal that the VC sees this month. So that's exactly the point. They're going to miss out on a whole bunch of companies that will make them a boatload of money. They're looking for that one or two companies that will be number one or number two. That is a really hard game to play because, frankly speaking, at the early stages, it's rather subjective. I was just actually talking with a founder this morning, and about this topic, and there's just so much subjectivity because there's no data, that it really comes down to a VC's gut around whether this is the best ROI deal. And so that's why it's challenging to pitch on that axis. The other thing is the process itself is challenging because VCs have mandates. These are agreements that they have set out with their investors for their fund. It's not their money. Like, some of it may be their money, but like with Hustle Fund, for example, we raised a lot of money from other people, other corporates, other angels, other VCs, other entities. And so we're managing their money based on this agreement that we had set out with them, explaining what we invest in, what we don't invest in, et cetera. A lot of people ask us, well, why haven't you invested in Europe or Africa yet? And that is like a global aspiration of mine, maybe for the next fund or whatever, but that is not in our current mandate that we have agreed with our investors. And so there are already a lot of filters just based on agreements with investors. In addition, the due diligence process has to be very buttoned up. And so for many VCs, that may involve multiple meetings. Like, first you may meet with an associate, and then partners, and all partner meeting, and all this stuff. And that may be more than 1 or 2 meetings, depending on the size of the VC and the size of the check. So I guess the long story short is, you're competing on a challenging axis. Like, you're competing on ROI, which is very hard to begin with. And then you have to go through this really lengthy process. And time is of the essence, as we all know, for startups. Flip side is the checks can be big. They can go anywhere from 25K for a small microfund, such as ourselves at Hustle Fund, to the millions if you're raising from a large sandhill VC. I think the last category, which I'll just briefly gloss over, is corporates. I know that these days there are a lot more corporate investors, so people often have questions about that. Corporates are not looking to maximize ROI, so if you are a strategic fit with a corporate, that could be good. But kind of like a VC, they have often a lengthy due diligence process. Each one is different and hard to assess, but it can be a lot of money. So that's sort of the gist of these three. So let's think about the framework here. Like, if we're basically saying an angel is any individual who can put money into your business, it actually is a lot of people. I think when most people think of angel investors, they think, oh, I'm going to go to AngelList and see who's active. I'm going to see if I can pitch Ashton Kutcher. And maybe you can, and maybe you can do both of those things. But the reality is that there are actually, I would say, 1 billion angels on Earth. Like, if there are 7 billion people, probably just shy of 1 billion have the net worth to be able to put some amount of money into your company. And I'm not talking about loads of money. Like I said before, there are plenty of people running around this town, like putting in $1,000 checks here and there, or even less. So you're talking about people who could, quote, spare $1,000 in a given year. And that basically opens it up to all professionals pretty comfortably. And so with that framework, then it's really a mindset shift. When I was raising money for LaunchBit, my ad company, I really struggled. I felt like, wow, I had this limited list of people that I can pitch. How am I going to ever pitch any more people? And the reality is that most people you should be pitching should not be on any directory or on any list. So when you go in with that mindset, the question is not, oh gosh, how do I make it work with these 50 or 100 people on my list? But more of, gosh, how do I triage through 1 billion people very quickly? And how do I pitch them such that it's not awkward because they don't realize they're an angel? So those are the questions we're going to answer in today's conversation. So when you think about it with that lens, then you're talking about, you could be pitching family, you could be pitching friends, friends of friends, coworkers, former coworkers, people you just met at a party, acquaintances, your dentist, your doctor, your lawyer. These are many people you've already interacted with just to set up your company.
Hey, Elizabeth, we're getting a lot of questions about this specific topic around the need to be accredited to be an angel investor. Is that something you want to address real quick since we're on the topic?
Yeah, certainly. So I think if you ask your lawyer, a lot of them would highly recommend that all of your investors are accredited. But legally, it is actually okay to accept unaccredited investors. So my recommendation here is, if you're going to invest, if you're going to open it up to unaccredited investors, I would probably try to do it through a platform that can really make sure that you're buttoned up on the legal side. So I think, I'm not 100% sure, but I think, for example, Republic has an option where you can basically do crowdfunding with unaccredited investors, and they take care of all of the legal work of, collecting the money, getting everyone signed properly. And I think it shows up more or less as one managed entity by Republic. I'm not a lawyer myself, so I would definitely confirm that. But that is probably the way I would go if you're trying to bring in unaccredited investors. And I've had portfolio companies that are actually doing phenomenally well and have gotten VC funding later that actually started out with platforms like Republic and took in $1,000 checks here and there. So it's not bad signaling either to do that. So this is actually kind of nice about raising money today as opposed to 3 years ago, when crowdfunding was really nebulous and this idea of taking money from unaccredited investors was not quite legally sanctioned yet. And I think today it's a lot more accepted. There are definitely companies doing it, and they're not seeing any repercussions or ramifications down the road either. Okay, let's hop into strategy. So how is it that you actually do this? We'll talk about tactics in a second, but at a high level, I think I just want to preface, like any fundraise, it's a numbers game and it takes time. And if you're not willing to put in the time, whether it's for VCs or angels, it's going to be really, really hard. I mean, fundraising is already hard no matter how you go about it. So I wanted to kind of illustrate like how we actually raised Hustle Fund 1, our first VC fund. When you think about it, actually, if you're a new VC, you have no track record with that brand. Even if you were investing before at somebody else's firm or as an angel investor, it doesn't matter. Like you're basically a pre-seed startup, and the pushback you get from institutional investors, the equivalent of Sandhill VCs, is, well, you have no track record, you have no brand on this new fund. So it's kind of early. That's basically the feedback you get. And so we actually raised most of Hustle Fund 1 through angels as well, like the same people who invest in our companies as angels. And so it really is a numbers game, because instead of like trying to raise $500,000 or $1 million, like we were trying to raise, an over $10 million fund. And so I want to give you a sense here with this graph, like this is what my calendar looked like for Hustle Fund 1. We started in mid-July or so, and this is just me, it doesn't even include my business partner, Eric. These are the meetings that I was doing in the beginning. And on average, you can even see from this graph, like my typical week, at least in the beginning, had more than 10 meetings per week. So that's the kind of volume we're talking about. Now, you're not raising 10 million, hopefully, through this method. Like by the time you raise 10 million, hopefully you have traction. But for many of you, you may be raising whatever, $500,000 or $1 million, let's just say. And this is this will be probably a more condensed time frame for you, but it will still generally look like this. Like instead of going from July until next May, it will look like maybe going from July until September or October. The second thing that we did is we did our own pattern matching. So what do I mean by that? Well, when I was raising money for my startup Launchbit, I had a couple of different stories. So my startup Launchbit was basically, for all intents and purposes, an ad network for email. And when you're an ad network for email, basically there are kind of two angles you can play just on the idea itself. You could position this as like a new ad play, or you can position this as like a better email tool of sorts, right? I think just very simplistically, like this is one of the best examples. And as it would turn out, actually, nobody resonated with the ad play. Like nobody's interested in writing a check for a better ad play. But the email story was very interesting. So I just like honed in on that as soon as I realized that was actually very interesting. And so as you go along, you may need to refine your story. Like for Hustle Fund 1, we did 20 versions of our story, like no joke. We kept on changing the story. I mean, obviously you're still doing what you're doing, but there are different angles or messaging that you can play on that. And so that's something that's really important to get feedback on and then iterate on and not be afraid to change in your deck. The second thing around pattern matching that we noticed for Hustle Fund 1 actually is around location. So these days I'm seeing more global investing. Like I think when I first started my ad company, people said, if you are going out of your location to be raising money, that's negative signaling. And I would say that there's still some of that sentiment today, because people will wonder, well, why are you here in New York when you're in California? Like, does that mean everybody passed? But I think you can answer that question better now. Like, I think if you have a good story to tell, I don't think people ask that question as much. So what we found for Hustle Fund 1 is, from a location perspective, actually even though from a numbers perspective, like a number of investors perspective, most of our investors for Hustle Fund 1 are from the San Francisco Bay Area. From a dollars perspective, we found that over 40%, I think it was close to 45% of our dollars came internationally. So that was kind of an interesting observation. And so you may find that for whatever it is you're doing, there's certain locations that work better. And if you're in a sector where another town is like more knowledgeable and comfortable with it, let's say, I don't know, media for New York or fintech or something like that, you may want to consider testing location. The third thing is with this mindset of, okay, there's an infinite number of investors I need to triage quickly, you don't want to waste time. So you want to just like actually figure out whether somebody is in or out immediately. Don't try to convince people. So ideally, actually, you're trying to win an angel over in one meeting. If you're talking about getting like a 25K check from somebody and it's taking you like 3 or 4 meetings, they're probably not interested. And I would probably even just nip it in the bud and say, you know, hey, I've really enjoyed meeting with you for these last few meetings, but we really are trying to wrap things up, and I just need to know like whether you're in or out, and like just cut to the chase. And it's okay if they're out. You want to get everybody to a yes or a no. So don't try to convince. It's just better to move on to a new lead, because really hot leads will convert like very quickly. I would say one meeting for an individual, and if they need buy-in from another party, whether it's a spouse or a family member, then maybe you have another meeting for each of those people. That's kind of my rough rule of thumb. So then the fourth thing from a strategy perspective is, okay, you want to close money quickly. So once you get a verbal commitment, you want to sign immediately. When I was raising money for my startup, it was the dark ages, and DocuSign and EchoSign and all of those were not around. Now there's really no excuse. Like you should have like a template queued up, maybe even on your phone, and just send it out immediately. Because every day that somebody doesn't sign, like they get less interested. Like people start to change their mind, they start to think about the vacation they want to spend money on, etc. And I think one caveat around closing, though, is you do want to be careful with who you raise from. I don't think it's a bad thing to be raising money from your dentist or your doctor if they know what they're getting into. Maybe they've done some investments before. I don't actually believe that every investor needs to be value add or helping you in your startup. Sometimes you just need cash. But what you don't want is you don't want people who are going to be a pain in the butt. Like you don't want somebody who's calling you all the time. You don't want somebody who constantly questions your decisions. And if you're starting to feel any of that, I would actually just walk away. And I know that's really challenging because people don't want to walk away from money, but in the long run, it is much better to have investors who are either value add or just like kind of passive and will leave you alone. Okay, so now let's dive into some quick tactics. Basically, with that framework of the world has, 1 billion investors, and this is how you kind of go through them quickly and try to, better pattern match, etc. So how do you actually do this? How do you have this conversation, etc.? Well, the first thing is I really want to emphasize that you should pitch everyone you know in pretty much any circumstance. So pitches don't just happen in an office. So I've actually pitched my optometrist twice now on Hustle Fund. He hasn't invested, but I think someday, maybe Fund 3, Fund 4, Fund 5, like someday he'll come in. But that's the kind of thing that I'm talking about. Where did I pitch him? Did I bring him to our office? No, we didn't meet at a coffee shop or anything. I was in my eye appointment. I have an annual eye appointment. That is my opportunity to pitch. I think the good thing about an optometrist, unlike a dentist, is your mouth is not filled with stuff. So you can actually talk, and it's really light, okay? I'm not giving a 30-minute presentation to my optometrist because I only have a couple minutes. But the conversation basically goes like this, like, oh, hi, how are you? And he's looking at the chart. He's like, oh, it looks like, you have 2 kids, and it also, how are they doing? And it also looks like you are running some sort of investment firm. When people ask you, how are you, or what are you up to, that is your cue to go in. And you're not pitching like a long-winded spiel. It's very quick, like 1 or 2 sentences. And so my response is like, oh yeah, I've been building a hustle fund, and we've been investing in a lot of great startups. So if you're interested in hearing more, I would love to chat with you about it. Very light. Most people will be like, oh, ha, 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 whatever. And you kind of move on. So you're not necessarily pushing very much, but you are planting seeds that they could potentially be investing, because I doubt my optometrist has ever thought about investing in my fund. If I don't bring it up, he's not going to think about it. It's not his full-time job to invest or whatever. As it would turn out, I've learned that my optometrist actually does invest in startups and funds. I didn't know this. He hasn't invested in mine yet, but that actually qualifies him pretty well because actually he's not a new person to this space. So that's the kind of thing you want to learn because that helps you. If somebody is interested, I have actually had people say, "Oh, I would actually love to know more," or whatever. So if you don't bring it up, nobody's going to think about it. The other thing around planting seeds is after that little bit of hi, how are you, whatever, what are you up to? The next thing you want to say, if the person is not interested or not seemingly interested, so the person says, "Oh, great," or whatever. If like, I would then do like one little poke on a follow-up after that, and basically it's like, okay, well, if you or someone may be potentially interested in investing, just one person, I would love to chat. And I think it's really important because the more people who know that you are fundraising, the more people who can potentially help you. You just actually never know where interests come from. And I think that the key thing here is to kind of isolate on one word. So I would make a very specific ask and mention, do you know one person? And the key word is like, well, key two words is one person who may potentially be interested in investing. And the reason is, like, if somebody asks me, "Oh, do you know anyone who could be a good developer or growth marketer?" It's like, well, yes, I do, but I haven't really thought about it. But if you're making a smaller ask, like, do you know one person? I think almost everybody can think of one person who might be potentially interested. It may not end up being a good lead, but everybody can think of one person in their entire life. And it may not even you're not even necessarily asking that person to introduce you to that person at this point. But it is a good conversation starter, like, "Oh, well, actually I have a friend who invests in startups," or whatever, something like that. And so we've gotten actually a lot of intros this way. Like, it's just one person, but you make this ask like multiple times a day, like, some of them actually go somewhere. And then once any one of those goes somewhere, those people generally know a whole boatload of warmer leads. So you're trying to look for someone who can lead you to a pocket of warm leads is basically the goal here. All right, tactically speaking, I often hear founders, say that, we're raising whatever, $1 million or something. And people get fixated on looking for a lead, like $500,000 or 250K or whatever. I personally think that this is a big mistake. And the reason is leads, people with lots of money, generally have very long due diligence processes. They generally have lots of people who need to weigh in. It takes forever and a day, and they're not writing very many checks in the first place. So your percentage chance of winning over a lead is generally small. The other thing is that a lot of people feel like leads, almost by definition, have conviction, but actually I found that not to be true. Leads need to be FOMO'd in as well. And so one of the strategies that I've used to fundraise, for actually both Hustle Fund and for my startup is to basically build momentum with smaller checks. So checks beget checks, because once you find somebody who is very interested, and by definition very interested in putting a check into your company, those people generally lead to more checks because they've got a warm inner circle of other people they may co-invest with or know people they invest with or who invest in general. So I actually don't think it's a bad thing to take very, very small checks. I often hear startups say, well, our minimum is 25K or 50K or whatever. With angels, I don't think that maybe with a fund, that's fine. But with angels, I don't think it's a bad thing to be taking, 1K checks, 5K checks, 10K checks here and there. For both my startup as well as Hustle Fund, we did take small checks. And guess what? Those small checks led to other people with small checks. And then all of a sudden you have 100K that you've raised. And that helps you generate momentum and FOMO for the 200K checks, et cetera. So it just like builds up from there. So even though it seems like, gosh, if I just keep on taking 1,000K, 1K checks or 5K checks here and there, will be very slow. The reality is you start to build momentum and if you get a flywheel going of more checks begetting checks.
Elizabeth, one question I'm seeing over and over again here is the concept of investors maybe being a bit hesitant to commit until they know that there's a lead investor. Do you have any advice on that?
So that's a good question. I think in general, I would say that those people tend to not be first movers. and that I would just park that in the back of your head and kind of slow play that person and go and find warmer leads. That's what I would do. I think one thing you can do to as much as you can try to pressure people is like, you know, I don't know, maybe you could, if you wanted to, like you could give them some sort of email-based guarantee that, you know, if we don't raise more than 100K in this time frame, then you know, then I'll return your money or something. Like that could be one way if you're in a market where you feel like people are generally more risk averse. But I think for me, now that we've raised a lot of money globally, including in risk averse markets, I've just found that in general, those people don't really convert even later. They're just like, people just need excuses or whatever, or need to try to get conviction, but it means that they don't really have conviction.
Sure.
So I think that the challenge, and this is actually a good segue into the next topic around tactics, is, well, then how do you just meet lots and lots of investors? Like if you believe the world has 1 billion angel investors, how am I going to get to most of these people or a bunch of these people? And how do I do it in a timely manner? So another tactic that has worked out really well, like outside of coffee meetings, is you can get bulk by throwing parties or events. And they don't have to be crazy. It could be a simple wine and cheese, go out and buy some cheap wine and cheap cheese and convince a friend to allow you to use like an office space or whatever. And so this is actually a picture from our early group of Hustle Fund 1 investors. Almost 100% of these people are individuals. Actually, I think 100% of these people are individuals, and most of them wrote really small checks. Even though Hustle Fund 1 is, you know, an $11.5 million fund, we took checks like 10K. You know, for a fund like 10K doesn't move the needle at all. And so we invited a lot of people to this party, and the people who were already committed helped us convince the other people at the party. And so we actually generated more checks off the party or more coffee meetings off the party. So that is a good way to basically filter people quickly. People who are not interested will basically just walk away, and that's fine. Another tactic that is a little bit less direct is asking friends to throw dinners. So some of my friends, for example, are way better networked than I am. They know very influential CEOs, etc. If I ask them to do an intro to one of their high-powered friends, they would probably be like pretty hesitant, right? Like even if I'm a friend of theirs, it's like, well, they don't know if my company is a good investment or whatever. They just may not feel comfortable. They also, it's often hard to ask friends about money situations, so that's a challenge. One thing that works really well is instead of asking your friend to do an intro for investing purposes, ask them to throw a dinner and invite all of these people, or a lunch or a breakfast. It doesn't matter what it is. And get all these people together, a small group of people, like, you know, maybe 5 to 8 people or whatever. And you are one of the guests, and these high power friends are also one of the guests. And you can even offer to pay for the dinner or whatever. Like that's part of your fundraising budget or whatever you should figure out for yourself. It doesn't have to be expensive, but then that allows you to then informally meet those people and then use some of the tactics we talked about earlier, basically soft pitching some of these other people. But now you're introduced, and it's not that your friend didn't have to get involved in the transaction at all. So one of the issues is with this process, you actually have like, you start going through a boatload of leads, right? You have the people you met at this party and at that dinner, and you went to that meetup, and you went to your optometrist this morning, etc. You start actually getting lots of leads pretty quickly. They're not all warm, but you start actually planting seeds, at least on some level, with multiple people, and then you start advancing them along. So I definitely, this is where it becomes really important to use a CRM. And so here is a very rudimentary CRM. I'm not going to belabor this point, but basically stay organized with a spreadsheet. You don't even have to pay for it, like Google Spreadsheets is good enough. So last couple of points, you're not hot until the end. Like that's how it always is. Like even for rounds that are oversubscribed, like actually in the beginning, almost every company that I've invested in or looked at that was hot at the end was quite slow in the beginning. I think that's just how it is. So even if you don't think, wow, like no one's really that interested, that's just like accept that. And this is a graph of our Hustle Fund 1 fundraise. You can see like we started in the summer, and we had no money closed, but we had a bunch of verbals to the tune of, you know, a little over 2 million, 2.5 million. And, you know, those verbals started going up. We did a close like in the fall, as you can see. And so the red line goes up. We had closed about 4. But as you can kind of see, we were somewhat stuck. Like we were stuck at, you know, call it 5.5 for many months. we had a whole bunch of people verbally commit and then maybe drop out or whatever, but like we were stuck. And then you can see at the end, it just zooms up. Like basically in the last 6 weeks or so, we managed to convert verbal commits into signed paperwork, going from basically 5.5 to 11.5. Isn't that crazy? Like raising $6 million in the last 6 weeks or so, 6 to 8 weeks, when for the prior 8 months or so, like it was like very slow progress. So that's just a good example of that. And that certainly applies to startups as well. So in summary, and we'll go right to questions. We have about 20 minutes left. Like basically change your mindset. Like the world has like too many angels. So you have to figure out how to triage quickly, work on your messaging, triage like crazy. Don't try to convince people. Keep track of your leads really well, and then use some of these tactics, parties, dinners, your doctor's appointments or whatever to try to get in front of people and soft pitch. So with that, you can, if you have more questions, you can email us. My Twitter is @dunkhippo33. You can sign up for our blog at hustlefund.vc as well. And we put out a lot of tactical tips and tricks on fundraising.
Thank you, Elizabeth. That was awesome. Kind of a speed round of that presentation. We've got questions pouring in, 130 unanswered questions, and then tons of votes on them. So let's dive in. This most popular question is, what's the best way to get in touch with angel investors, which I think we covered for the last about 10 minutes or so. If you guys have specific questions on some of the tactics that Elizabeth mentioned, go ahead and throw those in the question section. The next biggest one had the most votes is about getting funding as a solo founder. Is this possible, or do you think that it's important to have a co-founder?
Yep, totally possible. I think, in all honesty, if you have a co-founder that you work well with, that of course helps you a lot because you have double the people power. But obviously, I wouldn't force it if you don't have anyone in mind.
Okay, great. There's a lot of questions in here about how to divvy up the cap table when you are accepting checks ranging from 1,000 to 10,000. Do you have any thoughts on cap table?
Yeah, so that's why I would go actually with a platform or service like Republic. I'm not putting in a sponsorship plug for them or whatever, but but something like that, and you can do your own research because they will handle all those logistics of like when you bring in 50 angels or whatever who are all putting in 5K checks here and there. How does that work? And that's why I say they can make that easier, because then it shows up as sort of one line item on the cap table.
Okay. Great. There's also a lot of questions around traction. How much traction is needed? What do angels want to see? And what if you don't have traction yet? Does that mean that you should wait on investing or keep plugging away?
Yeah. So the unfortunate answer is it depends. I think just in general, the more traction you have, the more investors will be interested, whether it's VCs or angels. But the question is it possible to raise money without traction? I think the answer is also yes. Like if somebody really loves what you're doing, like it's a very admirable mission or whatever, like I think people would be more likely to put money in or whatever. Or if you have some sort of track record or people really love you or whatever it is, use those other angles rather than trying to pitch on ROI. And but I would say that the subset of angels who would be interested would be less. And so if you, as best as you can, like get to a certain level of traction, like without any investors of any sort, like that's obviously better and it will make your fundraising process faster. So I see it as a trade-off of time.
Okay. Tim had a question, and I got quite a few upvotes. Here it is. If an angel says they'd be comfortable investing a specific amount, let's say 10 grand, but you've set a minimum of 25K, their target is too low, what are some tactics they can use to push that amount up? And if that's not a good idea, or is that a bad idea? If it is a bad idea to try and push that amount up, then how do you strategically decide whether or not to take that smaller check?
Good question. So I think if you think that person could do more, like that person has invested 25K in other people's businesses, then I would probably push on that. Like, hey, would really love to have you in, but our minimum really is 25K because we're trying to, be mindful of handling logistics. In reality, logistics is not a problem, but like you can say something like that. However, there's a lot more angels who would be able to write like a 5K check, but cannot write a 25K check. So you're opening up your market to angels, basically, if you are willing to accept smaller checks, right? So the question then is it easier to take a 10K check from somebody who says that they are right, they're ready to write the check right now and ready to sign right now, and they can introduce you to people who could potentially, and maybe that's part of the bargaining here, is like, well, our minimum is 25K. I would really love to have you in here, but can you help me, like, introduce me to other people who can get me to where I need to be? And that in some sense is more valuable to you, right? Like, it doesn't really matter to you whether, two people come in for 10K and 15K, as long as they're both not a pain in the butt, versus somebody who comes in at 25K. So if that is an easier thing to get, I would go for it. And I would just basically frame it as, well, this is our minimum, but I'm making a special exception for you, and use that as a bargaining chip. And so I would really love your help on X. Like, that's probably how I would play it.
Your help on X being help me find another investor to get the rest of the money, and or some other thing.
Help introduce me to friends, like, especially if this person's well networked, or throw one of these dinner parties or whatever. Like, kind of use it as a bargaining chip because I'm doing you a favor.
Okay, good tip. So Hafiz is asking how important storytelling is when positioning a startup to an angel.
Oh, very, very important. I think storytelling is important just in general throughout, but I think even more so if you don't have traction, right? Like, it pretty much is a decision based on you and the story. And so I would, like I said, for Hustle Fund 1, we iterated our story 20 times, like, no joke. And there are different, and so basically this is where you take some feedback from the investors you're meeting and figure out what is that people are really latching onto or not latching onto. What are they getting really excited about, and can you play it up even more? So I think, like, as a concrete example, like, most people are not doing anything that is going to, I don't know, cure cancer, let's say. Maybe some of you are, but like, most people don't have startups that are doing that. But you can build a story around something as inspirational as that. Like, even for my email ad tool, okay, ads and emails are not inspiring, but you want to build a story around that. Like, if, like, with this tool, we can really change, like, the kind of content that people get, and change the way that they, the way they get information, and it will make the world better because of ABC. So I would really tie your story to something much bigger, like, very inspirational and heart pulling.
And keep iterating that story until you find what really works.
Exactly.
Okay. All right, switching gears a little bit. We've got a lot of questions about what's the best tactical way to kind of get a deal through the pipeline. Are we using safes, convertible notes? And for people who aren't super familiar with those terms, could you explain a little bit about what those mean?
Certainly, and we can send a link to a post that I've written, kind of dissecting equity, convertible notes, and safes later. I think for angels, since you're talking about collecting a whole bunch of, generally small checks here and there, nobody is actually a lead putting in $500,000. I would raise this money, assuming you're not working with VCs who are leading. Like, I would raise money on convertible notes or safes, or convertible securities, safes, or 500 startups as the KISS. And I think the punchline is they're all relatively similar in that they are placeholders for equity. And so, but what I really like is that they're templatized. Like, if you go to the Y Combinator website, they have their safe there. You can download it. It's free. And you just fill it in and put it through some electronic program and get people to sign electronically. And so then your cap table is very straightforward. There's nothing crazy. I think the problem when angels try to create their own equity rounds is, like, often they don't do it in a very standard way, and then that creates a mess later when VCs look at your company. So that's why I would do it this way, because it's templated and everybody understands it, and everybody has accepted that companies, like, can raise money in this way.
Okay, so here's a specific follow-on question from somebody with a sort of a specific situation. They've been raising a pre-seed round on safes with a consistent cap. But they've been getting some good interest from other investors, and so they've been increasing their cap table. They'd like to have more angel investors join the round, but they're wondering if a higher cap table is going to scare them off. Should they keep a smaller safe cap for those angel investors?
The higher valuation caps. Yeah, so this is a good question. So I think just a quick context setting. The other thing you can do, and one of the reasons why I like both convertible notes and safes, is that it allows you to basically raise tranches. So in the old days, if you were raising 750K and you were just starting, it was really hard to get momentum because everyone was like, well, you're raising so much money, I'm going to kind of wait, etc. There's no incentive for me to come in now. If you are raising a smaller tranche of, oh, well, I'm raising 200K at this special valuation cap on this safe, so there's only a limited supply of this particular round at this valuation, then you can create FOMO from that, like basically limiting your supply at this valuation cap. So that's another thing that I like. So what this company is doing is they're basically doing that. They're raising some money on this cap and then increasing the valuation of their company, and raising more money on this cap, et cetera. So that's the context for the question. I love that strategy and I think it works really well. So here, however, I would caution you that in convertible notes and safes, often there's like a most favored nation clause in there, meaning like once you drop the cap, for subsequent investors, and everybody who is invested at a higher cap also get that drop as well. So you can certainly take it out, but I think even in the spirit of things, if I invested at this valuation cap and I found out somebody else got a much better deal, I think in the spirit of things, I would still not like that unless we're transparently addressing that. If you find though that an angel is potentially more value add than your other investors, what I would probably do is I would probably still have them invested at the same higher cap that you're now raising at. But if you want to make it more lucrative for them, then I would grant them some advisory shares. So the net on that valuation is less for that person, but it is not framed as their investment deal was a better deal, if that makes sense. So that's probably what I would do in this case.
Okay, great. So with the 8-ish minutes we have left, I want to make sure that we get to 2 sort of question topics. Those question topics, for those of you wondering if you should stick around, are raising in markets outside of Silicon Valley, and then also outreach to angels, which we talked about already in your presentation, but there's a lot of questions about cold emails to angels. So I wanted to make sure that we address those. So the first topic that everyone would love to hear from you about is raising in markets outside of the Bay Area. How do you get in touch with people? What's a good way to get interest in those areas if most people want to invest in companies in Silicon Valley? I know you have a lot of thoughts on that. Go ahead.
Yeah, it's harder, I would say, but it can be done. So like for us, for Hustle Fund 1, I mean, I basically, like I had 0 contacts in many of these locations, but I started even just remotely so that I didn't have to spend the money to go to these places, but just started by having conversations with the couple of people I knew in some of these places who were tapped into these startup ecosystems. So friends who had started companies in these other ecosystems, or people I knew who were now building businesses here, but were originally from other cities, and getting to meet their friends, etc. Everybody knows like 1 or 2 people, and that's how we started as well. And it was a lot of work. And then basically, like even if you are not pitching for money like other founders, you are pitching them for mindshare and for introductions. And so I would very much take this approach with every single person you end up talking to. And so it ended up becoming like a long chain. We ended up getting quite tapped into some of these inner circles in some of these cities because we were meeting like, oh, that founder I backed 4 years ago who is building a startup here, or that other founder I know from San Francisco who has a brother over there, or whatever, and then meeting their friends and their friends and their friends. So it's roundabout, but that's exactly like how I would do it.
So keep plugging away and keep the relationships strong.
Yep.
Okay. And then another question that we're seeing a lot of is around cold email. Does that work? And if so, what does a good cold email look like?
I think cold email works much better for VCs, especially micro VCs. So some of the newer VCs, many of the newer VCs read cold emails, and you can email them directly, and that's great. For angels, remember, like many of them don't see themselves as angels. Like you could be cold emailing a lot of the people on AngelList, and that may be okay. Like I don't know if Ashton Kutcher reads cold emails, but Mark Cuban does read cold emails. So I don't think that's a bad thing. But what I'm talking about here is if you want to really open up like your market, if you will, if you want to really open up your market of angels, like you're talking about a vast majority of people who don't even see themselves as angels and who may or may not have even invested before and who are only just, a cold email would not work for that group of people.
Okay. Moving on to another question. We've got some people in the group right now who feel that they don't necessarily have what they think it takes to get angel money. If they're not a technical founder, they're not in the Bay, their product has a very long sales cycle. Do you think that they should continue to move forward in trying to get angel money, or pursue another avenue for funding?
I think, well, not knowing the specifics of the circumstances, I think my rough rule of thumb is, let's say you're fundraising right now, and if you have legitimately been able to get in front of 50 people and you have not gotten any like warm bites or near warm bites, and that's subjective, then I would go back to the drawing board and think things through. Like maybe you're not far along enough or something along those lines or whatever. But I think if you have legitimately gotten in front of about 50 people, like you should start to see something. It will not be a high percentage of people. Like you're probably talking about 10%. Like our close rate, is probably roughly around 10%. I would say that's actually quite good. So that's why I mentioned 50, because like even if it's 1%, you would probably see like a bite or so, right? And so this is what. But I think often I hear founders say, "Well, I'm really struggling to fundraise," and then I'm like, "Well, how many people did you talk to? 10." And so I think I really want to emphasize this is a volume game. Like you have to be getting in front of tons of people before you even start to get some bites. As you could see even from our own fundraise for Puzzle Fund 1, and I would even say that we're pretty well connected. Like after we exhausted our connections, like we were just stuck for months. Like you saw in that graph, we were stuck for months. Like we didn't raise any money, and that's just kind of what it is. And so it's a matter of like this trade-off of time. Like maybe your story's not right, and you don't have the traction enough if you are finding you're talking to lots and lots of people and you get no bites.
Okay. Gina has a kind of interesting situation. She's got a bunch of users. She's not charging for her product yet, so they're not customers technically. Soliciting is like illegal, right? Or at least very heavily frowned upon. Is there a way for someone like Gina to reach out to her existing user base to let them know that they're open to angel investors without breaking any laws that you know of?
Oh, actually, yes. And this is why I would, again, go to some of these platforms. Like, for example, on Republic, like I think they will tell you, and I sound like a walking ad for Republic, but I think they do kind of tell you about that. Like, for example, this media company called The Hustle, whom I helped advise like in the beginning with their conference, HustleCon, they actually raised a lot of money from their subscribers. And they did that in 48 hours through one of these platforms. So it definitely can be done. I would just kind of look into the details with one of these platforms on that.
Great. And then can we talk in the last few minutes about the due diligence process? What does that look like for an angel? Doing due diligence on their company. What are they looking at?
It should be pretty quick. Like basically, do they like this or not? Like that's why I say the hottest, like I've had people commit to things like in one meeting. If you're not getting like, my rule of thumb is like if it only requires one decision for every decision maker, that's probably roughly the number of meetings you need. So if it's an individual, who doesn't have to answer to anybody else in the family or whatever, like that person should be able to decide in one meeting. Maybe you want to give that person a buffer and take 2 meetings or whatever, but it shouldn't really be longer than that when we're talking about small checks. And by small checks, I'm talking about even 25, 50K, and certainly for 5K and 1K and 10K checks, like they shouldn't be wasting your time.
Okay. And the last question, I think is probably a good timing here, is how do you close some soft commitments this time of year due to the holidays?
Yep. So I think the holidays are really challenging for VCs, right? You're not going to go through anybody's processes if you haven't already started. Maybe some of you are wrapping up processes. But the good news is at this time of the year, there are actually a lot of holiday parties of all kinds between now and New Year's and everything. Oh, I'm sorry. That's my parking alarm. I need to move my car. So you'll go to these parties, you'll meet a lot of people, friends, family, friends of friends, etc. This is a great opportunity for you to tell everyone what you're up to and to inspire people to meet with you and plant the seed in their head that you are raising money. So it's actually good because these people are going to all the places you will be.
Amazing. Great. I know we still have a lot of questions coming in. We are at time. So, Elizabeth, thank you so much for that speed round of question and answer and for going through your presentation. For everyone who's still on, there's a lot of you. Thank you for being here. We have recorded this. We will make it available. We will try and answer some of these really hot button questions just over digital content and send them off to you, and hopefully see you guys again at another one. And happy holidays.
Happy holidays, everyone.
Okay, see you later. Oh, here's Eric.